Okay. I didn't bring my charge. So if connection is even if the connection is just abruptly disconnected, just please understand, okay, the situation, okay? So I didn't bring my charge, okay? All right, so today we will talk about the interest rate. So in the last class, I already introduced what we will talk about the chapter in the putting things in perspective, which is the front page of chapter 7, interest rate. So in this chapter, we will talk about the cost of money and interest rate level first. So in that topic, we will figure out some the cost of money, the factors, fundamental factors affecting the cost of money. And then second topic is the determinants of interest rate. There are a lot of the determinant components to determine the interest rate. So we will figure out what kind of the factors to affect the interest rate. So don't be confused of the first topic and second topic. First topic is we will talk about the first topic from the point of the company who want to raise money. So at the time, we will talk about cost of money or cost of capital from the point of the company. Second topic is more, the popular, more the common concept. So we will figure out the determinant of interest rate on more common concept. And third topic is the term structure and yield curve. As you shall see, term structure present the relationship between time to maturity and yield to maturity. Yield to maturity is the return in the bond, especially. So there is some special particular name of interest on bond, which is called as yield to maturity, YTM. So in the third topic, we will figure out the relationship between yield to maturity and time to maturity, which is called as term structure. And the yield curve is the graph to display the term structure. Okay, so yield curve is the sort of graph to display the term structure that present the relationship between time to maturity and yield to maturity. Okay, and fourth topic is estimation of future interest rate. As you shall see, there are a lot of the theories to explain yield curve or the term structure. So we will talk about the most basic theory to explain the yield curve, which is called as pure expectation hypothesis. Pure expectation hypothesis, PEH. So we will talk about that topic. And last one is we will study macroeconomic factors that influence interest rate. So, there are four kinds of factors to affect the interest rate. First one is cost of money. Second one is determinant of interest. Third one is the macroeconomic factors. So don't be confused of the first, second, and last topic. Okay, so all of them are related to the interest rate level, but the first one is from the point of the company. Second one is the most common thing. Third one is from the point of the macroeconomic factors. Okay, so don't be confused of those kind of three kind of the factors, right? Okay, let's take a look at the cost of money first. There are no PowerPoint to explain the cost of money. Instead of the PowerPoint, you need to take a look at the textbook, page number 235. 235, cost of money. So as I told you, there are four factors, the four most fundamental factors affecting the cost of money are production opportunities, time preference for consumption, risk, and inflation. In the page number 235. From the point of the company, there are four fundamental factors affecting the cost of money. Cost of money means cost of capital. From the point of the company, cost of money. So first topic, we need to figure out the factor to affect the cost of money. Cost of money or cost of capital from the point of the company. So if company wants to raise a fund, then company may issue the stock or may issue the bond, right? So in both of them, once the company borrows the money, then the company should pay interest or dividend to the bondholders or stockholders. Okay, then how those kind of interest rate or cost of money can be determined as you shall see. Okay, so there are four factors. So before we talk about this one, let's take a look at the basic the relation between the money supply and money demand. Okay, so x-axis is the quantity or dollar. X-axis is quantity or dollar. Y-axis is interest rate. Okay, so we'll say the supply curve and demand curve. So supply demand curve can, we can use the supply and demand curve in not only this kind of the cost to explain the interest rate, but also all of the economic situation, right? So the supply curve shows upward, demand curve shows downward because if interest rate is increased, then the more the guy who have money want to supply the money, right? So the supply curve, so therefore supply curve shows upward, just like that. On the other hand, demand curve shows downward because if interest rate is decreased, then the increase is the decrease, then the demand is the increase, right? So interest is increased, then demand is decreased. So demand curve shows downward, just like that. So supply curve and demand curve just like that. So interest is determined in this point. Okay. Then from the point of the company, we may think about the four factors to affect those kind of interest rate level. Right. First one is as in the textbook, production opportunities. Production opportunities. So from the point of the company, if the company has the opportunity to make a lot of the goods, then company want to more money, right? More money. Then what kind of the line shift? Definitely demand curve shift to the D1 from D0. So if production opportunity is increased, then the demand curve move upward, move D1 from the D0, right? Then what happened in terms of interest? Interest rate is increased from I1, I0 to I1. Okay, so if production opportunities increase, then the demand curve shift to D1 from D0, which result in the increase of interest rate. Okay, that's the first factor to affect cost of money. Second factor is time preference for consumption. Time preference for consumption. So from the point of the company, if the company want to have the more money at this point rather than future, then what? By the same token, the demand curve is increased, shift to the D1 from D0 if the today's consumption preference is higher than the future's consumption preference, then the demand curve shifts to D1 from D0, then interest rate also increase to I1 from the I0, right? That's the second factor to affect the cost of money. Third factor is in terms of risk. Risk means what? From the point of the lender, risk can be defined as the probability that the lender cannot receive the payment of interest and the principal. That's the risk. Risk can be defined as just like that. So from the point of the supplier, if risk is increased, means the probability that the lender receive the principal and interest is decreased, then the supplier, lender are not willing to supply the fund, right? So struggling with the supplying the funds, right? Then the supply curve change from S0 to S1, just like that. Okay, if the risk is increased, then money supply is decreased, which result in the shifting the supply curve to S1 from S0. Then interest rate is also increased to I0 to I2, right? From I0 to I2, okay? From here to here, so interest rate is increased. And last factor to affect the level of interest rate, the cost of money is the expected inflation. Expected inflation. If the supplier, from the point of the supplier, they expect the inflation, increase of inflation, then they are reluctant to supply the money, right? So by the same token, as in the third factor, money supplies decrease to S1 from S0. So interest is increased to I2 from I1, I0. Okay. So other than this factor, we can think about the other factors, but we would say there are four factors, main factors to affect the cost of money, cost of capital from the point of the company. Okay. So that is the first topic in this class, cost of. So we figured out the factors to affect the cost of capital. Okay, that's the first factor, first topic. And let's take a look at let's continue the interest rate. Let's continue to talk about the interest rate level more. So 7.2 explain how interest rate level is changed in page number 236 of to the 238 to 39. Okay, so interest rate levels. So 7.2 in page number 236 of textbook explain how interest rate is changed. Okay, so if you take a look at the figure 7.1, there are two graphs there, right? So we have two markets, market L and market M. We assume there are two markets, market L and market M. So we assume in market L, low risk securities traded in the market L stands for low, just we assume, okay? And the high risk securities can be traded in the market M, market H, high. Okay. So, and the x-axis is the dollar, the quantity or dollar. Y-axis is the interest rate, same as the previous slide. Okay. So, in both market, money supply, there exists money supply and money demand. Okay. So money demand, money supply, demand, supply, demand, supply, right? So let's suppose there are two markets, which are market L and market H. And this is the market L. This left-hand side graph shows market L. Right-hand side graph shows market M. So let's assume the interest rate is 4%, 5% in market L. Okay, and in market M, interest rate is 7%. We assume, right? We assume. So definitely in the high risk, in the market H, that is being traded high risk security. Definitely the supply function in the market H is lower than supply amount in the market L. That is traded the low risk securities. That's the common, right? So this graph is the more close to the y-axis rather than this graph, right? So that's why 7% interest rate is set 7% by using the intersection point of the supply function and demand function, demand curve. Whereas in market L, low risk security, market L that is traded low risk security, and interest rate is at 5%. Okay, so we would say 7 minus 5 is gonna be risk premium. Okay, so the reason why the investors want to invest their money in market H that are traded in the high risk security is because why? They want to have the more return. How much? 2%, right? 7 minus 5%, 2%. So even if the investor can enjoy the 5% of return, if they invest their money in low risk, the market L, but the reason why the investor invest their money in market H is because they want to have more return, as much as 2% in this example. Okay, so if we assume just like that, then page number 237 of second paragraph. Now let's assume that because of changing market forces, so market is always change. Okay, market is always change. So if market condition is change, how come? Investors perceive that market H has become relatively more risky. Okay, so let's if we assume that the market H, the risk is increased, then the supply curve now shift to the left hand side, just like that one, right? To S prime. So when we compare the two graph, market L graph, market H graph, I draw the S line is more close to the y-axis in market H because this is more risk. So if the market is risk, then the total amount of supply is decreased. So the supply curve is more close to the left the y-axis rather than this one. By the same token, if the risk is increased, is getting riskier, then the supply curve is now shift to the S prime from the S. Then the interest rate is increase, for example, 8% from the 7% in the market H. Then we assume that there are two markets and the amount of supply, total amount of supply is fixed. Okay, for example, 10. Then in this example, the total amount of supply is 6 in market L, 4 in market H, for example. But if the market H, the securities that are traded in the market H is increased, then total amount of supply is decreased to the 3 from 4, right? Then total amount of supply, money supply is the fixed, okay? Then this remain the reduced one is moved to the low, the market L from the market H, right? Then the supply curve in market L is the shifted to the right hand side, just like that. That's S prime, 2 prime. Then the S2 prime interest rate is now 4%. Okay, then now mark risk premium is now not 2%, but 1%. 4 minus 4 is the 4%. Okay, so as you can see, interest rate is changed just like that. So the reason why I explain this kind of things with the example is to introduce the how interest rate is determined. Basically, interest rate is determined depending on the supply function, supply and demand function, money supply, money demand function. But in each market, supply function and demand function is always changed. Okay, so most important thing to change the supply function and demand function is, as I told you, prime rate or base rate, 기준금리, right? 기준금리 in Korean, prime rate or base rate set by central bank in most of countries. So in the US, FRB set the prime rate or base rate. Here in Korea, not exact Central Bank of Korea, but some committee, 금융통화위원회 in Korean, Financial Control something, 금융통화위원회, 금통위, we would say 금융통화위원회, 금융통화위원회 in Korean set the prime rate here in Korea. So in each country, there's the institution to set the prime rate. Most of the member of that committee is there's a public the role. So once prime rate or base rate is set, then this prime rate and base rate affect the short-term interest rate. Short-term interest rate affect the mid-term interest rate. Mid-term interest rate affect the long-term interest rate. So all of the change of interest rate in various market is totally depends on base rate or prime rate. So that's because the prime or base rate is so important. Okay. So far we talked about cost of how can there are some factors to affect the cost of money, cost of capital, and how interest rate is changed. Okay. Now, let's take a look at the nominal interest rate and the real interest rate. Hold on a second, please. I turn off the air conditioner. It's full now. Okay, so nominal interest rate and the real interest rate. So you need to distinguish the real interest rate from the nominal interest rate. If you take a look at the page number 240, equation 7 point, I will explain later on. Okay, so before we talk about determinants of interest rate, you need to know what nominal interest rate is, what real interest rate is. Okay, so we would say nominal interest rate R without any suffix and exponent as R is represent any nominal rate, whereas R star represent the real interest rate. Okay, so and IP is inflation premium. So nominal interest rate is equal to the real interest rate plus inflation premium. Okay, so most stated rate, expressed rate is nominal interest rate. Okay, but the more important thing is the real interest rate. So the interest rate that affect our real life is the real interest rate rather than nominal interest rate. Okay, so we'll say the Fisher effect. What is the Fisher effect? So how can we figure out this equation first? Fisher effect. This one is 1 plus R. In other words, 1 plus nominal interest rate can be calculated by 1 plus real interest rate times 1 plus inflation premium. So if we rearrange this equation, 1 plus R star plus IP plus R star times IP. 1 in each the top each side is wiped out. Then the remaining is R, nominal interest rate, is equal to real interest rate plus inflation premium plus real interest rate times inflation premium. But this term is very, very small. It's almost zero. So we ignore this last term. So remaining one is the nominal interest rate is real interest rate plus inflation premium. That's the Fisher effect. So, and more exact, the definition of Fisher effect is just like that. As inflation increase, so if the inflation premium move to the left hand side from the right hand side, then R star equal to R minus IP, right? We move to the left hand side from right hand side in front of inflation premium. Okay, then if we express this equation just like that, then the R star equal to I minus IP. In other words, real interest rate is equal to the nominal interest rate minus inflation premium. This is the Fisher effect. So Fisher effect is just like that. As inflation increase, real interest rate falls. Real interest rate falls unless nominal interest rate increase at the same rate as inflation. That's the more exact definition of Fisher effect. Let me see again. As inflation premium increase, real interest rate falls unless nominal interest rate increase at the same rate as inflation. In other words, if we want to keep the real interest rate, fixed interest rate, then what? Nominal interest rate should increase as much as inflation premium. Otherwise, real interest rate is decreased. Okay, let me see again. If you want to keep the real interest rate, then nominal interest rate should increase as much as inflation premium. Otherwise, the real interest rate decrease. For example, my salary, okay, you know, here in Korea, the tuition to college was very expensive comparing to other countries, especially European countries. European countries, the tuition is almost nothing, zero, right? I'm not sure, but yeah. But here in Korea, Japan, US is the most expensive. Japan, Australia, New Zealand, or Korea is the second or third rank in terms of the tuition. So we, you know, the freeze the tuition of the for last 10 years. So if the tuition is freezing, then the salary for the faculty is freeze, right? So my salary is same thing during the last 10 years. Okay? At least 1%. Okay. All right. 1% increase. Okay? 1% increase. 1% means what? So if we change this is the, you know, the salary increase, because the real salary increase, nominal salary increase, and the inflation premium. Okay? If we change the terminology, then nominal salary increase 1%, but the inflation premium in last 10 years is 5% up on average. Then my real salary is what? Decrease 4%. That's the real. In real life, this is real example. So I'm a very poor. All right. So that's the fear effect. Okay. So if you want to keep the real interest rate or real salary growth rate, then the nominal growth rate, nominal interest rate should increase as much as inflation premium increase. Okay, that's the Fisher effect. All right. And this is the most important thing in this chapter. So the second topic. So then what kind of the factors to affect the interest rate, common interest rate? We'll say what is the determinants of interest rate. So this is the nominal interest rate, right? So nominal interest rate, in other words, required rate of return if you are invest your money in on debt, on bond. Okay, so interest rate is equal to the required return on debt. So especially interest rate or required return is called as yield to maturity on especially debt, as you shall see, yield to maturity. So anyway, at this point, interest rate can be composed of real risk-free rate, R star, which is expressed real risk-free rate of interest. IP is inflation premium. DRP stand for default risk premium. LP stand for liquidity premium. MRP stand for maturity risk premium. So the more the explanation, more detailed explanation is in page number 240. 240. The equation 7.1 there, and the definition or explanation of each terminology are there. Okay. So R is the quoted or nominal or stated interest rate on given security. R star is the real risk-free rate. And R star plus IP is nominal risk-free rate. Okay, this sum R star plus IP is the real risk-free rate. Real risk-free rate. Okay, risk-free rate. So we used 3 months treasury bill. 3-month treasury bill rate is used as nominal risk-free rate in reality. Okay, 3 months, the treasury bill, 3개월 만기 재정증권. Here in Korean, 어두워, 나 여기 차려. 3 months, 왜 스테이 어두워? 어딨지? still 3 months treasury bill is used as a risk-free rate. Okay, so This risk-free rate can be determined by economic situation, macroeconomic situation. All right. And IP is the inflation premium, as you already talk, as we talk about, right? IP inflation premium. So inflation premium is the, if you take a look at page number 240, inflation premium is equal to the average expected rate of inflation over the life of the security. Okay. And the DRP is the default risk premium. LP is the liquidity premium. MRP is maturity risk premium. So default risk premium is the, we should ask more return to the company whose credit rating is lower, right? If the company's credit rating is lower, which means what? The probability that the interest and principal is repaid is decreased. Okay, so for example, there are many layer of the credit rating. So triple A is most credible. The company's the credit rating. Double A, single A, triple B, double B, single B, C, D. It depends on credit of the company, right? Credit agency, credit rating agency provide the credit rating to the company. So definitely, if you compare the company whose credit rating triple A and double B, for example, then definitely the probability that the principal and interest is not be paid on time is higher in the bond issued by the company whose credit rate is double B rather than triple A, right? So this bond interest rate is much higher than this bond interest rate. Why? Due to the default risk, right? So default risk premium reflect those kind of the risk, right? Default risk premium. So definitely double B's default risk premium is higher than triple A's default risk premium, right? So that's the default risk premium. And in reality, default risk premium, how can we calculate the default risk? What kind of things can be used to estimate the default risk premium? 3 years corporate bond minus 3 years government bond rate, especially double B, triple B. Triple B, triple B, triple B with triple B credit rate. Definitely, for example, 3-year government bond interest rate is 3%, for example. Then 3-year corporate bond with triple B's credit rating is 7%, for example, 9%. Okay, so the gap between the 3-year corporate bond with triple B's credit rate and the 3-year government bond is used as the default risk premium in real life. Okay, default risk premium. How about the liquidity premium? What is the liquidity premium? Liquidity premium, default risk premium. So the default risk premium, this premium reflects the possibility that the issuer will not pay the promised interest or principal at the stated time, right? So that's the default risk premium. How can liquidity premium can be defined? LP, liquidity premium. This is the premium charged by lenders to reflect the fact that some securities cannot be converted to cash on short notice at a reasonable price. Okay, that's the liquidity premium. So liquidity premium is just like that. Even if the company is very healthy, in financial condition, but there's some the liquidity problem, then the company may be bankrupt. Okay, for example, if you, so for example, Junse has the one apartment with $1 million apartment, $10 million the building. Wow, you are so rich apartment. But in the wallet, in the Junse's wallet, only $1 there is there, $1, 1,000원. Okay, so even if he is very rich, but the amount that to convert the cash is very limited. Okay, so the Junse can convert this kind of the asset to the cash. How? Junse cannot but sell this the fixed asset, but it's not easy, right? Not easy, and it is very time consuming work. Okay, so but if the Junse should repay $1,000, so if compared $1,000 with the 11 million, it's very putty, right? It's very putty amount, right? But Junse cannot pay this $1,000 unless Junse sell this the asset. That is called as the liquidity risk. So if this is not Junse, not individual, but the company, then there is some the reason to be bankrupt in terms of the company. That is called as liquidity risk. So liquidity premium reflect those kind of risk. Okay, that's also liquidity premium. All right. And last component to determinant of interest rate is maturity risk premium. Many of you guys are confused of the maturity risk premium with the default risk premium, but two risk premium are totally different thing. Okay, so maturity risk premium is the, as you shall explain later, long-term bonds, even treasury bond, are exposed to significant risk of price decline due to increase in inflation interest rate. So maturity risk premium, I will explain the maturity risk premium more detail. So to understand the maturity risk premium, you should know the mechanics to determine the bond price. Okay, so there are two bonds, A and B. So bond A is 1 year maturity. Bond B has a 10-year maturity. Okay, 1, 2, 3, 10-year maturity. Then how can bond A, the bond price, how can the bond A price is determined? Interest plus principal divided by 1 plus R. That's it, right? In this equation, R is the return to the investor from the point of investor. Yield to maturity, this is changed to yield to maturity, same thing in bond. How about the bond B? Interest at first year 1 plus R, plus interest second year 1 plus R square, interest that I receive year 3 divided by 1 plus R to the power of 3 to get the present value, right? As you know, the time value of money, and interest plus principal that I receive 10 years at maturity, 1 plus R to the power of 10. Okay, then if interest is increased, interest may increase or decrease, right? If interest increase, then price is changed. Okay, how can prices change? If interest is increased and price is 준서. If interest is increased, prices If the interest is increased, then prices, other conditions are same constant. Interest is increased, prices,
Decrease?
huh?
Decrease?
Increase, decrease. Left hand side, right hand side.
Decrease?
Increase,
Decrease?
decrease, right? Decrease, right? It's common, right? If denominator is increase, then PA is decrease. PB is decrease, definitely decrease, right? So if we compare price of A, that is the fundamental logic to determine the bond price. Okay, so bond price is always the reverse related to the interest rate. That's the most fundamental mechanics to determine the bond price. So bond price is totally reversed related to the interest rate. Okay, so maturity risk premium means what? If you compare the 1 year and 10 years, so if the interest is increased the same amount, then the portion of the changing bond B price is much higher than the portion the amount of the changing of the bond A the A bond price, right? So bond change amount of changing bond price of bond B bond is much bigger than the price change of the bond A. Okay, so and another thing is what probability that interest is changed is in bond B is much higher than the A because this is 1 year, this is 10 years, right? So during the 10 years, there's a high probability that interest is changed rather than 1 year maturity. That is called as maturity risk premium. So maturity risk premium is totally depends on related to these kind of things is called as interest rate risk. Interest rate risk. Interest rate risk can be defined as if interest increase, the risk, the price decrease. That is called as interest rate risk. So interest rate risk in bond with longer maturity is much higher than the interest rate risk of bond with the short-term maturity. That is called as maturity risk premium. So maturity risk premium is all about interest rate risk. Okay, interest rate risk. So this R star plus IP is called the risk-free rate. This is determined by the macroeconomy, right? ERPN, LPN, MRP, DRP and LP is totally dependent on the company, right? So different company has different default risk premium, different liquidity premium. It depends on the company's the financial situation. Maturity risk premium is not related to the company. This is the maturity risk premium is just period maturity, right? Period. So, for example, Hyundai Motors issue the 10-year bond and 30 years bond. Okay, 10 years bond and 30 years bond. Let's say the Hyundai Motors issue the 10-year bond and 30 years bond. Then which bond is higher interest rate, provide a higher interest rate, definitely longer maturity, right? In this case, real risk-free rate, inflation premium, same thing, right? Default risk premium, liquidity premium, identical in both 10-year bond and 30 years bond because the economic situation can be affected to the 10-year bond, 30 years bond is identical manner. And this bond issued by the same company, so default risk premium and liquidity premium is same thing in both 10-year bond and 30 years bond. Only difference between 10-year bond and 30 years bond is what? The difference of maturity risk. So definitely 30 years bond has the more maturity risk premium rather than 10-year bond. So a 30 years bond is higher. The interest rate of 30 years bond is higher than 10 years bond. Okay, so there are 5 factors to affect the interest rate, and each factors comes from the macroeconomic company and maturity. Okay, so this equation you should remember this equation because this kind of logic can be applied to many other the aspect. Okay. So if we classify the bond with each premium, so definitely treasury bond doesn't have any default risk or liquidity risk. So the treasury bond don't have any default risk premium or liquidity premium, but corporate bond has those kind of default risk premium and liquidity premium. Right? Inflation premium, all of the bond has the inflation premium regardless, who issue the bond. And maturity premium can be existed only long-term bond, right? Long-term bond. In short-term bond, maturity risk premium will say nothing. Okay, so each bond has different source of risk premium. Okay. So, and the third topic now, the third topic is yield curve and time to maturity. Yield curve and time to maturity. So as I told you, term structure present the relationship between interest, y-axis is interest rate or yield to maturity, x-axis is time to maturity. So the period to wait to get the principal, that's time to maturity, right? Time to maturity. So term structure present the relationship between yield to maturity and time to maturity. Okay. Term structure present the relationship between yield to maturity and time to maturity. And the yield curve is the graph of term structure, this one. In other words, yield curve shows the relationship between yield to maturity and time to maturity in graph, right? So yield curve. So term structure is very important thing in bond price, the analyzing of bond. So there's the course name is fixed income security, right? Fixed income security. Professor Yun is now the teaching fixed income security, 채권론, right? 채권론. So I'm not sure, but more than 50% of contents of fixed income security course is related to the term structure. Term structure. Okay. So the term structure is so important thing. Okay. So term structure. So what is the more exact, interest, depending on the period, that's the term structure. So the term structure shows relationship between interest rate or yield to maturity and the time to maturity, okay? And the yield curve is a graph of the term structure. So as you can see, yield curve display shows the upward, just like that, as of May 2011, flat, February 2000, or downward, March 1980. Other than this shape, there may the hump shape or the U shape, many type of shape. But we would say there are three popular yield curve. Out of these 3 popular the yield curve, what graph is most popular? So yield curve is generally downward or flat or upward. Virginia,
Yes.
Yeah. Which graph is most popular in terms of the yield curve? Downward, flat, or upward? You can consider what I told, what I, figure out, what I tell you, what I told you.
Like which one of those three?
Out of three, downward, the yield curve may be downward, may be flat, may be upward. Which one is most popular?
The
Which
flat
one?
one?
Green one, red one, or a blue one?
Maybe the flat one, the red one?
Red one? Why is that?
I don't know. I don't know if it's correct.
So far, I explained a lot of things about maturity risk premium, right? Maturity risk premium. Then, which one is most popular? 정욱, 윤정욱. Yeah, which one is most popular shape? Blue one, red one, the green one. Blue one, exactly, right? Upward slope is most popular due to the maturity risk premium, right? So the longer maturity, the higher risk, as I told you, right? So maturity risk premium can be defined as the probability of the change of the price when interest rate change. So the longer the period, the higher the possibility of the change of interest rate, right? So the blue one is most popular shape of yield curve. Okay, so the May 2011 Treasury yield issue. The reason why I wrote down this one, this is the most popular one, right? Then why some yield curve shows downward? When, as you can see, if current interest rate is so high, so if you compare green one and with the blue one, current interest rate is 14% in green one, right? Whereas the blue one is only lower than 2%. Okay, so current interest rate is so high, then what? Long-term interest rate may be lower than short-term interest rate. If current interest rate is so high, but so we'll say this is the weird situation. 장단기 금리 역전 현상. We'll say in Korean. So the reverse situation of long-term interest rate and short-term interest rate. Generally, long-term interest rate should be higher than short-term interest rate due to the maturity risk premium, as I told you, right? But as of some point, short-term interest rate is higher than long-term interest rate for some reason, okay? So if the short-term interest rate is higher than the long-term interest rate, then the yield curve shows the downward, just like the green one. But the blue one is the most popular one. So a long-term interest rate is higher than the short-term interest rate. This is the more the reasonable, logical thinking, right? And logical situation. So blue one is most popular one. This is the specific situation, okay, when current interest rate is high, okay? So the answer is here, right? So hypothetical yield curve. So we'll say this is the real interest, real risk-free rate is fixed. The real risk-free rate is fixed. Inflation premium is increased as time goes by. Time goes by, upward. Maturity risk premium is also upward, increase, right? So upward slope of all the sloping yield curve is the general one. Okay, so upward slope due to an increase in expected inflation premium as well as maturity risk premium. Okay, so the reason why the yield curve shows upward because inflation premium and maturity risk premium increase as time goes by, right? But if you take a look at the figure 7.5, what happened if the yield curve shows the downward? So there are two graphs there. So left hand side, the yield when the case of yield curve is increased, this is the risk-free rate is fixed, and inflation premium is increased. And maturity risk premium is increased. So inflation premium is the increase as time goes by, and the maturity risk premium is increased. So the yield curve shows just like blue one, right? But what happened if yield curve shows a downward? So if you take a look at the in more detail in in the case of downward yield curve, risk-free rate is fixed, same as, right? And the inflation, as I told you, why the yield curve shows upward downward, inflation premium is decrease. Decrease, right? Inflation premium is decrease. Inflation premium is decrease, right? Not increase, decrease time, because the current interest rate is so high. But even if yield curve show the downward, so this yield curve, right? Yield curve shows a downward, but what? Maturity risk premium is increased as time goes by, right? So even if yield curve shows downward, inflation premium shows downward, but the maturity risk premium is increased, regardless of shape of yield curve. Okay, that's the figure 7.5. So even if yield curve shows an downward, maturity risk premium shows the increase, right, as time goes by. So we would say the reason why the yield curve shows a downward because the inflation premium is decrease, okay, rather than the amount of the increased maturity risk premium, right? So if the current inflation premium is so high, then the yield curve may display the downward. Okay, and this is the I already explained that one. So the relationship, if you take a look at the relationship between the treasury bond yield curve and corporate bond yield curve, corporate yield curve higher. Corporate bond yield curve are higher than that of treasury security, as I told you. The default risk is higher in corporate bond rather than treasury security, right? And though not necessarily parallel to treasury curve, the spread between corporate and treasury yield curve widens as the corporate bond rating decreases. So as I told you, if you take a triple A or single B, so you'd say double B, single A, double A, single A, triple B, double B, single B, CD. So we would say this one is the investment grade, and below the double B is the speculative grade. Speculative grade. Okay, so you've heard about junk bond, right? Junk bond. We can make the bond whose credit rating is below double B. So that we can mix we can make the bond with mix of the bond credit rating is less than double B. Okay, so that's the junk bond. So definitely junk bond interest rate is higher than the investment bond. Okay, so as you can see in the graph, y-axis is the time to maturity, axis is the yield to maturity. Then definitely in the bottom there's some the treasury yield curve. In the middle there is the AAA rated bond, and in the top there's a double B, C, B, D. Okay. So if we illustrate the relationship between corporate and treasury yield curve, then just like that one. Okay. And the last topic of this chapter is pure expectation hypothesis. So as I told you, pure expectation hypothesis is the contains that the shape of the yield curve depends on investors' expectations about future interest rate. Okay, so as I explained, the reason why yield curve shows upward because we assume the future interest rate, long-term interest rate is higher than short-term interest rate. That's why the yield curve shows upward. Okay, so there are tons of theory to explain the yield curve or term structure. So as I told you, term structure is very important thing in bond valuation. So there are tons of theories to explain the term structure. And out of tons of theories, the most fundamental, most basic theory to explain the yield curve is pure expectation hypothesis, PEH. So if you take the fixed income securities taught by Professor Yun, then the Professor Yun may be able to introduce a lot of the theories, but in financial management class, I will introduce only one theory, which is very, very fundamental, basic theory, which is called as pure expectation hypothesis. Pure expectation hypothesis. So if interest rate are expected to increase, then long-term rate will be higher than short-term rate. Then yield curve shows the upward, right? But the vice versa. So the long-term rate is lower than short-term rate, then the interest rate the yield curve decrease. Thus the yield curve can slope up, upward, down, even bow. Okay, so that's the pure expectation hypothesis. So there are tons of theories to explain the term structure or yield curve. One of the most fundamental, one of the basic theory to explain the term structure is the pure expectation hypothesis. Okay, and what is the assumptions of the pure expectation hypothesis? Let me stop here because in the morning session I stopped here. So let me stop here. Okay, any question about interest rate? So interest rate is very important because this one, all of things we are talking about is important, right? Important because this is the fundamental cost. So we can apply those kind of things we study to lots of ways. Okay, so all of the things we cover are the important. This is the the fundamental because due to the fundamental concept. Most of the things are fundamental concept. Okay, so in next class we finish up the pure expectation hypothesis. In the middle part of pure expectation hypothesis, we need to use some the basic calculus, okay, or exponential calculus. So we need to finish up the chapter 7 and we will talk about chapter 8, risk and return, which is another the fundamental concept. Okay, so and chapter 8 is the last chapter to be covered before the midterm exam. Okay, so the chapter we will cover the the chapter and form page first page of the chapter 8 in next class. Okay, any other question? 질문 엄사?
Professor,
Yeah.
could you see the chat, please?
Do you what?
The chat.
Chat? Okay. Oh, all right. Exercise. I will think about it. But exercise. Okay. So, in terms of the essay, I don't think you be able to. I mean, there's some the practice, but the calculation, you need to do that. So. One of the method to the the exercise what we covered is to the homework. Okay, so I will give you homework the this Thursday or next Tuesday. So through the homework you can exercise the what we covered in terms of calculation. Okay, so if you do the homework, then you can figure out what kind of thing we should do to prepare the exam. Okay, Virginia?
Yes, thank you.
Okay. Any other question? Okay, if you don't have any question, let's take a look. Let's see the this coming Thursday. Bye. Fortunately, the connection is not disconnected, right? 누구요? 예. 예, 과제는 다 계산하는 문제로 나와요. All of the homework are related to the calculation questions.